And joining me for a closer look on what's playing itself out in the market scene is Cobus Potgieter from Southern Across Capital. Cobus, always a pleasure. Hello.
Good afternoon. Thanks for having me, Nalatanda.
Let's talk about the week that was, Cobus. I think on Wednesday, actually, we had a wonderful day on the JSE. It was green screens all around. Yesterday was the total opposite, red screens all around. And today in midday trade, it looks like we've got a little bit of this and a little bit of that. Let's just talk about this performance that's choppy, if we may.
Choppy, yes. You use all of these water analogies. The other one is treading water. The markets are treading water. And that's been the case all week. I guess we're a bit battered with the negative inflation and consequent, deferred expectation for rate cuts from the Fed. And that's been the theme all year. Frankly, it's been difficult for markets to find real direction. And this week in a little microcosm is sort of more of the same. If we take it on a week by week basis, it's really the MSCI World is up 0.5%. The S&P is up 0.5%. The Euro stocks are up 90 basis points and the JSE is down about 50. So, and currencies haven't done that much either, sort of moves between 0 and 40 basis points have been par for the course across the board. So, very little concrete news, and I think that rally we saw earlier in the week was more of a relief rally than anything else, because the stocks have been a bit battered of late, particularly the industrial stocks.
I want to ask you about the rand and how that's fared in the face of that hotter than anticipated inflation data.
Yes, so obviously initially we saw dollar strength. I see that's now abated a bit. But where we really pick it up is in the bond yields. Our bond yields are around the peaks that we saw in Feb again now. So the bonds under serious pressure, and certainly we're still seeing continued selling of South African bonds off the back of this news. While the yields had really stabilized a bit about a week ago and hit a low, and we're looking a bit more healthy. Now they're looking way more attractive again. We've got the R186 or 186 trading around 9.1% again. So that's very attractive from this level, and just shows that rate expectation is sort of being deferred. The probability of a hike in the first 2 quarters of the year are diminishing rapidly.
I want to reflect on some stories that came out this week before we move on to what we're seeing today, Cobus. I'm really keen to get your thoughts on Standard Bank. I think you would have heard Zanati and I's conversation earlier. We saw a 27% increase in headline earnings coming out of Standard Bank. I think a strong showing from the bank, but the share price was down 6.81% at close of business yesterday. I'm just keen to get your thoughts here. What are market participants not quite happy about where the Standard Bank results are concerned?
Honestly, I think markets, given the trajectory we saw in H1, we're looking for around 30. But make no mistake, this is still a set of results against a peer group that is struggling by comparison to eke out, a return on equity in excess of 11-12%. So this is a stellar result by any means. And some of the provisioning is somewhat conservative. So if you look at this on a sort of a medium-term basis, this is not a bad, it's still on track. The CEO very specifically pointed out that they are still on track. They're happy with the KPIs they're hitting, and ultimately, yes, the market was disappointed. Perhaps it was priced for perfection, but some of that has turned around today already. It's up around 2% today. So if you were sort of brave enough to buy into that sell-off yesterday, you managed to top up your position at a nice enough discount. And I still really like that ticker a lot. I think it's still the pick of the bunch, and perhaps it's offering a little bit more value than it did 2 days ago.
And let's get into some capital news from today. Maybe starting off with Oceana. It looks like a reasonable performance for them. What I did flag here is decreased volumes from Lucky Star. Now, we've been speaking about Lucky Star as the shining star of the brand because, of course, that is affordable protein. But with decreased volumes, Cobus, not sure what to make of that.
No, well, I suppose I have to understand any operational constraints, and I haven't delved in that deeply. But beyond that, obviously, we know the consumer's under pressure. We saw this in other Tiger Brands results as well. So beyond that, it's difficult to make any intelligent comment. I'll be honest. Oceania in general, it sort of shows that having a rand hedge product, a dollar priced commodity, um, with reasonably good pricing of late, in this environment, even with lower volumes, gives you a lot of protection, which is really nice for them, given that the ZAR has been so weak and all of their input costs are in rand.
And then touching on Lipstar, they also came out with a set of numbers today. What I flagged there, Cobus, their headline earnings are up, but they're saying that's based on an insurance claim and also just less impairments than anticipated. That does tell me that the buoyant performance isn't from operations, it isn't from sales, it isn't from volumes.
Yes, I'm not fond of that business. I'm not fond of management. I believe they lack credibility. They have a history of not guiding the market well and engaging in a way that uh, could be considered less than less than ideal disclosure in terms of forward expectations and performance. And for that reason, and then the nature of the business, the kind of business which on the face of it looks attractive enough, but sort of lacks pricing power where they sit in the value chain. Ultimately, it gets a very poor rating. And this, if they did have a somewhat improved operational performance, which, as you pointed out, doesn't seem all that real, given all the once-offs. And again, the once-offs are not a problem because we can adjust for them, but we have to be able to trust management's judgment. So when management calls something a once-off, sometimes it isn't. And a management team that has a history of not guiding well, the market tends to not give that much credence. So it's a difficult one to touch. And for the foreseeable future, I wouldn't be interested in Lipstar.
Always great to get your thoughts, Cobus. I'm keen to get your stock pick, actually, but before we do that, I'd like us to reflect on counters that have found favor with your industry peers.
Anglo's looks interesting, particularly because Billiton is the higher quality operator and it's lower risk. Anglo's has got a much higher risk profile because of the PGMs, the platinum and the diamonds, which have been under significant pressure. But if you take them as a percentage of earnings now, they're well below 20%. If you add the two together, it's maybe 15, 16% of Anglo's earnings. So the risk to earnings is significantly reduced. You've got the prospects for iron ore and copper still embedded in Anglo's. And then you've got the optionality should platinum kick up from here or diamonds start to recover. We are seeing signs of a recovery there as well. So I think Anglo's looks interesting at these levels. I would start buying. I'm not saying now's the moment and go all in, but I would start buying here, and I think it looks interesting.
Results was very good, but well guided for, and perhaps the guidance was a bit disappointing. But if you take a 2 to 3 year view, I still think the Standard Bank are well positioned. First of all, their balance sheet is very strong. If you look at the capital adequacy ratio, their provisioning is also quite high, so they will have a lot of room for any potential surprises. If it doesn't happen, you can unwind those provisions as well, which will boost earnings growth rates. They can also increase dividend cover even further if they want to. So I think there's a lot of options on the pool, and they do have some actual growth potential. Despite the dismal economic conditions in South Africa, they've been growing quite well over a few years. Strong franchises, good management. I think if you are willing to wait a little bit, you will make a decent return, especially perhaps in the second half of this year or first half of next year when interest rates do start coming down and perhaps risk on sentiment towards emerging markets start getting better. And of course, the elections in SA also something in the past. I think that will help a little bit because you do need foreigners to buy our companies, specifically the banks, because it tends to be quite a consensus buy from a professional investors at the moment, which concerns me a little bit. But I do think that when the foreigners do come back in, that will give that extra layer of growth ahead for the banks.
My stock pick for today is Anheuser-Busch, going a little bit defensive. You know, I think as you can see by a number of these results that we spoke about today, and you know some of the recent consumer or retail sales print and everything we've seen, the consumer is clearly under pressure. You know, I like the fact that this is a bit of a more of a defensive play, and you know we're still expecting sort of double-digit growth in earnings going forward. So yeah, my stock pick today is Anheuser-Busch.
Keen to get your thoughts on those. I think we've spoken Standard Bank, so Anglo American as well as AB InBev.
Told your producer before. It's so easy when I agree with all the picks. I don't think that's happened before. So I like all of these picks. Anglos, I agree, is interesting. If you were invested in a hedge fund, there were a couple of guys that called this value because you can. If you can short out that platinum exposure, and that ramp inside Anglos has actually done particularly well relative to the resources basket. And there's another technical reason to be buying Anglo at the moment, which I'll get to when I talk about my own pick. AB InBev, another luckily Cobus said, very defensive pick. Good business, good growth baked in, and the technical reason for getting into that one at the moment, and I'm not talking technical charts, I mean liquidity events that create opportunity. Altria, one of the major holders, or the major holder, offloaded a chunk of their holding yesterday, and that sort of puts an overhang because a lot of investors had to come in and absorb billions of dollars of liquidity in the stock, and it sold off significantly in the wake of that. So if you wanted to get into AB InBev, now is the time to buy. It looks like you know, sort of a 5% cheaper than it was a week ago, purely because of that liquidity event, because of a major shareholder exiting. So if you do like it, you like it even more now because nothing has fundamentally changed. There's additional liquidity in the market, and that has made the share price depreciate. Now's the time to get in if you do like it.
And with that said, which counter are you loving this afternoon?
So my counter is Mondi. Again, is something I used to, when the market used to consider blue chip, well managed, excellent management team. They've had some frustrations because of the war in Ukraine, and specifically their Russian operations, and having to exit that. Of course, we got a really fat dividend from the sale, and those proceeds being distributed to shareholders. So you do need to take that into consideration when you look at the share price graph. That doesn't tell you the entire story. Now, the technical reason I was alluding to before with Anglos is there's a bit of homogenation going on with the JSE indices, where the so-called grandfathered stocks, which are stocks that moved their primary listings offshore in the wake of '94, but were considered for all intents and purposes to be local stocks. They were upweighted in the JSE named, so call it the top 40 and the all share index. They were upweighted in those indices, and for that reason, they were well held by index trackers. That is coming to an end. They're going to be more fairly weighted the same way the other stocks are going forward. And there's an homogenation going on between those JSE labeled indices and the SWIX. So on that basis, there is selling from the index trackers, which could cause in the next couple of weeks a bit of an overhang. And the three names affected are Anglo American, Mondi, and Investec. So on that basis, again, I'm not saying buy it because there's an overhang. I'm saying if you do like it, and I do at this level, you might be able to get in a bit cheaper still off the back of this particular selling relative to the rest of the market. And that creates a nice entry opportunity if you're going to buy into the stock in any case.
Super insightful, Cobus. Thank you so much for that. And it's always a pleasure having you on Business Lunch. Thank you for your time. That was Cobus Potgieter from Southern Cross Capital.